Hey everyone, welcome. Thanks for joining. We'll just give it a few seconds while a few other people are just joining in. Yeah, thanks for joining us. We should only take about 30 minutes or so of your time. I'm sure everyone's doing things, but yeah, we'll go 30 minutes, quick presentation, have some questions at the end. So yeah, some of you may know me. I'm Bo. I'm one of the partners here at Highview Accounting. Jake was also going to be here, but he's a late apologies. He wasn't feeling too well, so he's apologizes that he's unable to attend. To my right here is Bruce. So he is our principal financial planner. So he'll be talking to us about some strategies potentially around what to do with the funds and saving tax as well, and Diabri here as well, which some of you may know has been working with a number of Zendesk employees over the last few years. Guys. So we've had a few requests to have the presentation recorded. So we're going to do that and we can send it around to everyone in the next couple of days. So we will block out any attendees' details, so none of that will be shown. And we'll also cut out the Q&A at the end. So we'll leave that off. We'll just be purely the presentation if anyone wants to look back at it later on. So just to say, the presentation, I guess, is general general information only. So none of this is, I guess, is financial advice or anything like that. So it's just general information. So please just come out to us and speak to us, because everyone's obviously situation will be different. So just very quickly, just in brief summary, obviously the Zendesk takeover. It was a couple of months ago, back in June. It was obviously announced that private equity firm was going to acquire Zendesk at $77.50 USD per share. Understanding is that's obviously still, I think, being approved by the board and things like that. But yeah, obviously that's expected to go ahead later this financial year. So yeah. So I guess, what does this mean, for you guys? Ultimately, it is a capital gains tax event, even though I guess, you guys aren't, selling your shares, so to speak. I guess they're being compulsorily acquired. It is a capital gains event, and we need to work out if there is a gain or loss on those shares. So done a couple of examples, where we've just, made up names and numbers, but essentially this could give you a bit of an idea of what to expect on tax time. The first example is we've got Chris here.
Hey, Bo, I'm just getting in trouble for 2 seconds. Can you guys share the screen? Because we only see you guys in the tiniest little snippet of the screen.
Okay, yep.
Just so everyone can see the examples, that's all.
Hold on, can you not see the slideshow on here?
Yeah,
I can.
Okay. Sorry, guys. Keep going.
Yeah, everyone can see. Yeah,
Right. Gets the heart attack there, Peter.
So made up example. So Chris here, would have been working at Zendesk, say, from 2016, started getting his shares in 2017. Maybe he hasn't sold too many of his shares, so he's accumulated quite a lot. In this example, say about 2,700 shares, still holding today.
Sorry.
And because obviously the Zendesk price has naturally gone up a lot in value over the last however number of years. The vesting price was going to be roughly $135,000. That has been the price when they vested, and Chris would have paid tax on that throughout the years. So at 2,712 shares, when you convert that to Australian dollars at $77.50 per share, it's roughly about $296,000 would be his proceeds when the shares get acquired later in the year, if it all goes as planned. So it's 296 is the cash that he will receive. 135 is the cost base, or the vested value that he's paid tax on already. So he's essentially going to have about $160,000 capital gain. Because those shares, or at least a very large majority, would have been held for greater than 12 months, Chris would be entitled to a 50% capital gains discount. So that $160 gross gain becomes like a net gain or a taxable gain of about $80,000. To put in perspective how much tax that would equate to, we've got 39% and 47% on the screen. That is, I guess, the top two tax brackets. So, anything above 180,000 of income is at 47%. And, 120 to 180 of taxable incomes at 39%. So, Chris would be looking most likely between that 31 to $38,000 of tax on that capital gain. Just one additional note: their Division 293 tax. Some of you may be aware of that, but that's essentially where if your adjusted taxable income goes above $250,000, the ATO takes another clip and they tax you an extra 15% on your super contributions. So, in this example, that could be up towards about $4,000. So second example here, Alex. So we've done an example where maybe you've only been at Zendesk for a couple of years. So in this case, Alex has about 580 shares from 2020 onwards. And this has cost Alex about $91,000 in the vested value. Naturally, as many of you would know, the share price obviously kept going up, and then it obviously has tailed off in more recent times. So in this case, the amount of the value that they vested at was higher than that $77.50 acquisition price. So, Alex's proceeds would only be about $63,000 AUD, whereas, the vested at $91,000. So, Alex has incurred a loss or a capital loss of about $28,000. Unfortunately, that capital loss can't be used to offset other income, such as, salary and wages. A capital loss can only be used to offset other capital gains. So there'll be no tax payable, but yeah, you will have that loss that you can't use unless there are other capital gains that year. And if there is no other capital gains, then that loss basically gets quarantined or warehouse, we call it, and it basically just carries forward to next year. And that'll just carry forward, for the basically longitudinal tax returns.
Okay, all right, thanks, Bo. That's interesting that some people have a capital gain and some will have a capital loss. It will obviously be very dependent on their own individual situation. And
yeah, absolutely.
The shares and how much they've incurred along the way. So probably with capital gains tax, I always put that in the category of a nice problem to have, because that's great, we made a gain. What we then need to do is to look at ways we can try and minimise the amount of tax that you pay. So one of the first obvious ones to talk about is, can we reduce the tax by making super contributions? So you might be aware that there's a cap called the concessional contribution cap, and that's the $27,500 that you can put into super, either you or your employer, and claim it as a tax deduction. So that potentially means that you might pay tax at 15 to 30% rather than up to 47%. So there can be a pretty significant tax saving there. We'll have a look at an example later, but just bear that one in mind. Then there's something called catch-up contributions, but there are a couple of rules around that, and they might allow you to make much larger contributions, potentially up to maybe $100,000, depending on your work history and super history. So to have those catch-up contributions, you have to have less than $500,000 in super as at the prior 30th of June. And then you can use any unused cap since 1 July 2018, so effectively the last 5 years approximately. So in terms of what to do with the proceeds, we would generally suggest people probably, if they've got tax to pay, so if they've got a capital gain, they've got some tax to pay, probably stick the money that you need to pay the tax in your bank account just so that it's there available, or perhaps drop it into your offset account if you've got one, and that'll save you some interest but have the money ready available. The second point we talked about is adding some money to super, which we've already touched upon. Probably debt reduction is another thing to look at. Reducing debt, particularly the non-deductible debt like your home loan debt, is often a key priority of many people when they come in to see Deborah or myself. And under that scenario, by paying the money off your home loan, you can hopefully save a fair bit of interest and also own your home sooner. And with interest rates rising, we've got another 0.5% today. It was. You get a bang for your buck out of debt reduction. Then some people might want to invest the money because they either don't have debt or they prefer to do the investment. And what they might be doing there is looking to get a higher return from investing it over the longer term compared to the interest that they might save on their loan. And particularly, I think it was one of the examples we had there was that one of the people had a capital loss. If you invest some of the money, the proceeds that you get, and then you let that grow over time, hopefully, and then you sell it and realise a capital gain, effectively, you can have some of that capital gain tax-free because you can take those capital losses that you've sort of warehoused, and then you can use those to offset the capital gain and effectively get some tax-free gains that way. So that can be a great option for many people. This is Chris from before. So just some made up facts here that I've done in conjunction with Bo. So Chris earned about $150,000 from work and no other income. And the tax bill that Bo mentioned before was about $80,000. I've just rounded it to $80,000. And based on that income, the tax bill is about $35,000, which was in between those two figures that Bo mentioned. Chris does have less than $500,000 in super as at 30th of June last year. And whilst he's had some employment contributions, he's still got 60,000 left in these unused contribution caps, including what he doesn't expect to use this year. So what Chris does is he seeks some advice. He comes in and sees Diabri, and we put a strategy together for him. And effectively what Diabri gets him to do is to drop $60,000 into his super fund. And the great thing, there's a bit of paperwork that needs to be done. We need to make sure it's all done properly. But basically, Chris will get a $60,000 tax deduction. Okay, and effectively that saves a whopping over $27,000 in tax saved, which is really quite significant. Now, unfortunately, it's not quite as good as that because there is a 15% contributions tax in this situation, which is $9,000. That's 15% on the $60,000. But there's still a significant over $18,000 tax saved, which is a great result from coming in and seeing Diabri. Probably one thing I would say is that it can be a bit of a puzzle what you actually do with the money. And so what we can do is, firstly, we should talk about structure. So are you going to invest in your name, or are you going to invest perhaps in a partner's name that has a lower marginal tax bracket? Or are you going to consider something like a family trust? And you should probably have a chat with Bo about that if you're going to do that. Or maybe even a super fund or a self-managed super fund. So you've got to get that structure a bit right. Then in terms of investments, you need to think about, is it just Australian investments or is it just international investments? And probably from the point of view of diversification, you should probably have a bit of both, some Australian and some international investments there. The next point is that in terms of diversification, there's things called ETFs or exchange traded funds. And effectively, that allows you to buy in one trade as a basket of shares, such as the ASX 200 or the S&P 500. And that can be a great way of investing and also reducing this, what we would call the specific risk of having all your money in one particular company, which has probably been the case for many of you. I would suggest with the Zendesk shares is that that's probably been your only or major investment asset. Investing in something like an ETF would give you the opportunity to spread the risk across different sorts of companies. Some people prefer to use managed funds, which is where you're getting a big broad spread. It's nice and easy. Property, some people think about investing in property, and that might require a larger capital base. You need to think about, are you going to have to borrow to do that? What type of property? Is it going to be residential or is it going to be commercial? If you are going to look at property, again, is it going to be in a family trust or in your personal names or joint names? Or are we going to look at something like a self-managed super fund? Then you also need to think about shares. Many people are attracted to investing in shares. With shares, though, there's probably a lot of work involved in that. You've got to pick the shares, you've got to manage them, know when to buy them, when to sell them. And so there can be a fair bit of work in that, and it can be hard to get diversified in your approach. So you don't want all your eggs in the one basket, basically. Then there's something called an MDA or SMA. An MDA is a managed discretionary account, and an SMA is a separately managed account. Basically, what that is a structure that allows you to hold and have direct visibility of a portfolio of shares, and that can include directly holding overseas shares like IT shares or other shares. And then there's a manager in the background that effectively makes decisions and works out when the right time to buy is, when to sell, when to increase your exposure to perhaps Australian shares, when to decrease it, and so on. And effectively then the aim there is that by using their expertise, you'll get a great result and some higher returns over time. So one thing I would suggest is that we can certainly help you put all of those pieces of the puzzle together to make sure that you've got a great investment outcome. And then starting off with perhaps speaking to Gabby about what the options might be. So in terms of next steps, you'll receive a follow-up email in the next day or two, which will include a link to the presentation that we've got here. I would probably be suggesting that you'll all want to individually speak to your accountant, either Bo or Jake, and find out about your own tax outcomes. If you want to explore more about the financial planning aspects, you can book a discovery meeting with Gabriel or myself. And probably the point there is, it's an important thing you to be looking at here, but do you have a plan on moving forward? So working with an advisor such as Gabriel and myself, we can actually provide you with some clarity about your situation, provide you some valuable insights, and then by working in partnership together, we can help you achieve what's important to you. I'd just like to touch on some of the benefits of ongoing advice. So what we did is we asked a number of clients that work with us on an ongoing basis, where they're coming in a few times a year. We're available to assist them with ad hoc queries and support and help them along the way. And these are the top 5 reasons why they want to take up and continue to take up the ongoing advice service, which we do charge a fee for. So for many of them, it might be peace of mind, knowing that they can sleep at night. It might be that they also don't have the time or the knowledge to do it themselves. Or even if they did, they're busy doing other things, so they want to outsource it to an expert. Potentially will help them make better investment decisions, and particularly stop them from making investment decisions based on what's happening in the market currently, which perhaps later, with the benefit of hindsight, they perhaps regret and say they were more emotionally based rather than factually based.